I'm gonna kind of add to what Steve said. I think the crypto market has been limping along since October 10th because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. I mean, they act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading. And if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities because of that unwind and now this sort of limping and weakened liquidity.
Well, Hey, what's going up, Bull Runners? Welcome back to the channel. Ryan Huggins here, aka Win with Ryan. And I'm sure you've all noticed the entire crypto market quietly bleeding out for weeks now. Bitcoin is down over 25% from its highs. Alts are getting wrecked even harder. And almost nobody can explain exactly why it feels so heavy. What if I told you one single behind the scenes player, a wounded market maker with a massive hole in their balance sheet, is quietly sucking air out of the whole entire market, and that this exact same thing already happened before and only lasted 6 to 8 weeks? Stick around for today's video. We're going to be breaking down exactly what's going on, why this pain probably won't last forever, the brand new XRP ETF that just launched into this market downturn, and the SEC's big privacy meeting coming up that could change everything for privacy coins. We'll head over to X to get the breaking news happening over there. We'll head over to Forex Factory and check out the red folder news that's going on this week. Dive deeper into the SEC to hold the Privacy and Financial Surveillance Roundtable. And as you saw in the intro with the video, Tom Lee is speculating wounded market makers. We're going to dive deeper into this. And at the end of the video, we're going to be jumping into the XRP charts, looking at the spider lines, the next level of support that you need to know about. Plus, we're going to be looking at our short-term and long-term momentum waves. If you're like most people where you don't have the opportunity to spend hours a day doing crypto research like we do for you every single day on this channel, make sure you subscribe right now. And if you are still feeling bullish about this current bull run, let us know by smashing that thumbs up and comment 777 down below. Heading over to CoinMarketCap, we're going to get the overall health of the crypto market today. It's at $2.94 trillion total market cap. $207 billion traded in the last 24 hours. Fear and Greed Index coming in at 11 out of 100. We are in extreme fear. Altcoin season index 28 out of 100. We are in Bitcoin season. Bitcoin dominance does still continue to drop, 58.1%. Bitcoin ETF inflow tracker, horrible day today, 203 to the downside, 75 million yesterday to the upside. So when we take a look at this weekly number, already down 755 million this week, last week over $1 billion. Ethereum also not doing so well today, over $18 million worth of outflows, 37 million yesterday. This week coming a total of $312 million of outflows for the ETF of Ethereum. We have a big shakeup in the top 6 of the cryptos by total market cap. Number 1 is Bitcoin, still at 85,800. Ethereum number 2 at 2,800. Tether number 3 at $1. XRP at $1.99 at number 4. BNB at number 5 at 864. But overtaking Solana now. USDC moves into the number 6 spot at $1, and Solana now is number 7 at $132. Red folder news that has come out this week. Unemployment claims. There was no forecast, but there was 232,000 unemployment claims this week. FOMC meeting minutes. FOMC did not happen due to the fact there is no data because the market was shut down for multiple weeks. The government average hourly earnings came out. Non-farm employment change is important because it was forecasted at only 53,000 jobs, but in reality, 119,000 jobs created. Unemployment claims also came in under the forecast, 227,000 forecasted, only 220, which is why they're light up green. Unemployment rate, though, is a little worse than forecast at 4.3. It is at 4.4%. Tomorrow, we're going to get manufacturing and services inflation numbers. I'll keep you updated. Make sure you subscribe and come back tomorrow. Speaking of those jobs numbers, the economy added a robust 119,000 new jobs in September. And one thing to keep in mind, these jobs are going to United States-born citizens, not foreigners anymore.
This is the September jobs report. Non-farm payrolls are up a robust 119,000. 119,000 would be the best since April, when we were up 158,000. If we look at labor force participation rate, it ticked up. That's a good thing. 62.4 equals where we were in May. You have to go to April of this year when it was 62.6 to find a higher number. If we look at the hours worked, and this is always important, it remains at 34.2. To find a lower number, you're going to January when it was 34.1. We have initial jobless claims. This is for the week of November 15th. As I said, there's weeks missing. We're expecting 227,000, comes in at 220,000. These numbers do not reflect nervousness in the labor market. They've been very well behaved. 220,000 would be the lowest level of claims since mid-July.
So that leaves people speculating, why is XRP crashing? Why is Bitcoin crashing? Why is the S&P 500 crashing? And why is the NASDAQ, and on and on? Now, the interesting thing is here, these are pullbacks. We don't necessarily need to say crashing. People are freaking out because they hold a lot of these things right now, as far as indices, cryptos, and so on. It is very scary if you're holding this portfolio and you didn't sell at the top, because the top was just a couple of days ago, October 6th, when the guy from 4chan predicted that exactly on October 6th, the all-time high for Bitcoin was going to hit. And sure enough, it did. And everyone thought that was fake. It was predicted back in 2023. On December 12th, 2023, he put out the previous all-time high. If that pattern were to continue, all-time high would be on the 6th of October, 2025. People want to believe otherwise, but the simulation will repeat itself. Again, this comes from December 12th, 2023. And if we take a look at Bitcoin and we go back to October 6th, which is literally the last green candle before the down move, that's got a lot of people spooked. Is the bull market over? Well, we are coming into a phenomenal support, and we'll get into the actual charts here in just a couple of minutes. But people are worried. We're getting good jobs numbers, etc. But the reality is the government just opened. So these reports are just getting cranked back up again. The flywheel needs to start moving. The big giant snowball needs to start rolling down the hill, and then we will get some more positive information coming out. But we do have some positive news for XRP, maybe not in the price necessarily. However, Brad Garlinghouse posting the pre-Thanksgiving rush, shall we say, turkey trot for XRP ETFs start now. Congrats to Bitwise Invest on today's launch. Milestone day for XRP community. This morning, the Bitwise XRP ETF began trading on the New York Stock Exchange. With today's launch, investors have a new convenient way to get spot exposure to XRP, the crypto asset looking to disrupt the $250 trillion market of global payments. So with that, as we talked about in the intro, Bitwise launched their XRP ETF with a 0.34% fee. So not super heavy, and that's waived for the first month. It traded over 610,000 XRP, worth $14 million on day one. Analysts predict that inflows from 12 spot ETFs could create a weekly demand of 1.14 billion XRP, potentially consuming the entire public supply within a year if the prices stay stable. That is phenomenal. We could finally see that supply shortage of XRP that everyone's talking about. XRP's trading volume dropped, though, 32% to 4.64 billion, with a 2.97% price decline to $2.11. Now currently sitting at $2. We'll get into that in the markets, marking a 12.21% fall over the past week. And Tom Lee is saying that this is all because of that massive liquidation. Now, if we go back and we look at the charts, we'll look at XRP's chart because it has one of the most gnarly, ridiculous liquidation candles here. As we see right here, this is the October 10th candle he's talking about. This day that happened, a lot of people speculated that Wintermute, which is one of the largest market makers in the entire world, may have potentially got liquidated themselves. They may have run out of money. And because of that, no one is able to provide liquidity for the entire markets, and prices have continued to bleed off over time. And if we take a look at this one, for example, the XRP perpetual contract, this is the trading with leverage. For those of you guys that know about trading with leverage, some of you do, some of you don't. By the way, there is a link down in the description to where you can get started for doing perpetual trading without having to use your own money. We have a promo code 777 to get you the best possible discount. But look at this liquidation candle here. This one came down to $1.17, which is one of the lowest that I've seen. And if we take a look at Bitstamp, a different exchange, their long liquidation curve down here was $1.58. So every single exchange had different liquidation levels because of the fact that market makers all got caught off guard as well on this significant drop.
Was the point that my very, very smart team behind me, we put together for the top of the show, which was showing that Bitcoin turned down today before the market did. All right, take us back. So October 6th, I think it was October 6th or 7th, Bitcoin hit 125,000. Yeah, a couple days later, it was still around 120,000. Now, obviously, Bitcoin's at 86 and change. So what specifically occurred on or around October 10th that would lead us to where we are now on what, November 20th?
Yeah. Well, Steve actually pointed this out. There's a lot of what they call automated processes in crypto. One of them is called ADL, okay, and that's an automatic liquidation feature that would take place if someone's account or their collateral drops in price. It's essentially like a margin call. On a specific exchange, a stablecoin's price varied from other exchanges. It actually, stablecoin should stay at $1. It dropped to 65 cents. But that only happened within the exchange quotes, within this exchange because of liquidity. That triggered an ADL, an automatic liquidation across many accounts. It wiped out as that spread across other exchanges, right? Because liquidations cascade. Almost 2 million crypto accounts got wiped out, even though minutes before they were actually profitable accounts.
So who is behind this? Like, who's the they in the market makers and they got hit? Who's the they?
Well, you know, Brian, I am aware of names, but because I'm not someone who wants to name names, I think what you should keep in mind is that this error is actually essentially a bug, a code error, because I think in retrospect, they would have pulled pricing from across exchanges to set the price for that stablecoin rather than rely on internal quotes. But this has resulted in a lot of market makers and traders having less capital. And as you know, as crypto prices drift lower because trading volumes drop, they need to then have more capital available, which means they shrink their balance sheet further. So this is then that reflexive weakening.
I want to go back to this point, Tom. I hate the term glitch. I can't stand the term glitch because, things go down at the airport and they say, well, a glitch caused your flight to not take off. That's not a glitch. That's more than a glitch. It's a word that is used to describe pretty serious automation issues, software problems, crashes, for some reason that they try to minimize. Is this some kind of a software bug that's causing part of this? I'm trying to follow exactly what you're hinting around about.
Brian, it is. For instance, in 1987, portfolio insurance was the quote glitch, and that triggered the cascade in 1987. And so the industry learned and then never offered that again. In 2009, it was really the collateral wasn't secure in real estate and these packaged subprime mortgages. Now, the industry learned and they recoded that. I'm talking about Wall Street, but then regulators came in and overregulated. That was the negative effect of that. In crypto, this code of ADL and the way they pull prices never going to happen again. The good news is we're not going to have overregulation in crypto, but now we have to deal with that liquidation effect. 2022 was a big liquidation, and it took 8 weeks. But that is kind of, you're right. It is the nature of DeFi where there is going to be code and there's going to be an error found. And you said it, leverage is what's dangerous. And so investors should not be using excess leverage.
Also, the SEC is going to be holding Privacy and Financial Service Roundtable in December. SEC officials will discuss common pain points and solutions, but no hard policy proposals will be submitted. Naomi Brockwell, founder of the Ludlow Institute, says authoritarians thrive when people have no privacy. When those in charge start being hostile to privacy protections, it's a major red flag. The crypto community also sounding the alarms. The verdict in the Storm trial and other cases where open source software developers have been convicted or imprisoned for creating non-custodial, privacy-preserving protocols has set a dangerous precedent for privacy technology, the United States legal experts have said. In August, Matthew Gigliotti, the acting assistant attorney general for the Department of Justice Criminal Division, signaled the agency would no longer prosecute open source software developers for writing code. He said, "Our view that merely writing code without ill intent is not a crime. The department will not use indictments as lawmaking tools. The department should not leave innovators guessing as to what could lead to criminal prosecution." This renewed interest in privacy tokens harken back to crypto cypherpunk roots, and one of the core reasons that cryptographic technology that underpins crypto was even invented in the first place, to ensure secure communication channels between parties in hostile environments. And that's what we've been talking about on this channel now. It is very dangerous. It's exciting to be a part of crypto, but the way that it's going, the adoption through government, where they're going to be able to track each and every transaction that you do. They're also wanting to have full access to your wallets to where they can turn on and off your crypto. You've seen that with many big players. Their USDC wallets were frozen out of nowhere. They had to, scream and kick and fight and try to get their money back. But the reality is this is much more difficult because it's still the wild, wild west. It's very exciting wild, wild west because you can create and do whatever you want. But then they want regulation to prevent people from doing fraud. And then the regulation comes in and the regulation go too far. And then all of a sudden now everything is tracked and you are under the dystopian finger of the government. And if they don't like what you say online, if they don't like that you didn't get a specific jab in the arm, if they don't like that you're not eating the right food or whatever, they can simply cut off your wallet. So good news is they are talking about safeguards to prevent that from happening. All right, so jumping into the charts here, we do have our spider lines up here on the charts on our traditional candle charted here. We can see we do have a support down here to the bottom. That is at $1.90. We've been talking about this one for a while since it broke below our $2.28 spider line. Now, these spider lines have been legit. You can see this one right here, unfortunately, rejected off of the 252. Also at the highs, we can see our previous all-time high on the daily. The wick broke through our highest bodied candle here, but you can also see our highest bodied candles, which literally touched exactly on our spider line right here. This one was from 355. And this one was the rejection candle at 355 as well. Now, we do know we all got up to $3.66. All-time high is fine, but that is really amazing because when we go back in time, we also take a look at that same dotted red line, and that was the high from January of 2025 that started the rejection and the pullback in January all the way until it bottomed at $1.80. In fact, it actually bottomed at exactly, let's remove this with the wick, one of our spider lines down here, $1.62, and started climbing back up from there. Now, if we want to go back in history, where did that red dotted line come from? It's actually from the drop of the 2017 and the 2017 all-time high, 2018 collapse. And it's on a weekly candle that is dated right here. We can see it. It's the March 19th, 2018 weekly candle. When you draw a pivot point with a ray tool on TradingView from that weekly candle and you pivot off the high, that high being the 2021 candle, it draws a line out into the future as we did with all of the weekly candles, and it gets you these resistance and support lines. And that's where we're at right now. You can see on this drop down, we've hit it as a resistance multiple times. There's wicks through it. The bodies of candles can't break them. They break down. That's actually the day before our ultimate drop. We can see we had a pump up into this $2.92 spider line, rejected. The next day it had a pullback, and then really that second day after the rejection off the spider line was the liquidation day. But right now, what we're looking for, a support at where we're at now, but at least not breaking below $1.90, climbing back up and starting to climb our spider lines like a ladder, 228, 259, 296, and we'll get back and check in with you after that. Now, if you do want to learn how to trade, check this out.
What if you could trade with $100,000 without ever risking any of your own capital? Well, I'm doing it right now, trading a 100K funded account with zero of my own money on the line. I just paid a one-time evaluation fee to take a trading test. That's it. Because everyone's been asking us, how do I get crypto loans? Or how do you leverage trade without risking any of your own capital? Well, that's exactly why we're leveraging Breakout, which is a crypto prop trading firm recently acquired by Kraken with over 10 million clients, 2.5 million funded accounts, and over $1.5 billion in revenue in 2024 alone. They will fund you up to $200,000 after passing one simple trading test. And you get to keep up to 90% of the profit, and you can withdraw in USDC 24/7 after passing the trading test through the link in the description of this video. Now, here's the problem that I've seen most people face. Let's say you're trading with $10,000 of your own money. That's your rent, that's your groceries, that's an emergency fund, and one bad trade or black swan event and poof, your account is completely blown. Rent's late, savings is wiped, and your family is stressed out. So you're not trading to win. Trading your own money is trading for survival, whereas trading with 100K of risk-free capital is freedom. In fact, if you only have $10,000, you should never be trading with all of that. Instead, if you took just 10%, which is $1,000, and you buy the 100K or the 200K breakout test, and you pass the test, well, you're going to be trading with six figures without depositing or risking any of your own money. This is what I'm doing right now. And if you fail the test, you only lose $1,000 instead of your $10,000 because you shouldn't even be trading with $10,000 of your own money in the first place if you can't pass a simple $1,000 trading test. And the best part is there's no limit on retries. So that $1,000 can give you 10 shots at a 100K account if you fail the first few. That's 10x better risk management. And that's how you prove you actually know what you're doing. And this is the smartest strategy that the best traders in the world use. That's OPM, other people's money. You pass the test, you trade Kraken's money, and you get to keep up to 90% of the profits. And you can withdraw USDC on demand 24/7. So I paid, I passed, and now I'm trading 100K, and it only cost me $1,000 rather than risking $100,000 of my own money. And now it's your turn. So do not buy the small test. You're here to scale your portfolio fast. So here's exactly what you need to do right now. I left a link in the description of this video, and when you click it and select the classic one-step 100K or 200K account test, you simply click start trading, and then you enter in the affiliate code 777 on your checkout to get the maximum discount on your 100K or 200K funded account. And make sure to check the add-on box for the 90% profit split. It's only $100 extra. It pays for itself in your first payout. And if you skip it, you're leaving 10% on the table forever. So it's well worth it. Then you simply pay for the test, you pass it, you have an unlimited time frame, and you get to keep up to 90% of the profits. And again, you can withdraw in USDC anytime that you want after you pass the test. That's it. Now, we do earn a small commission when you use our code 777, but it supports value-based videos like this, and it'll help you get the maximum discount on your 100K or 200K funded account test. So click the link in the description right now, take the test, and let's get you funded.